Welcome to another edition of Taking Stock for the week ending the 21st of February 2025. That's the third week of reporting season. I'm Kien, Head of Research at Stock Doctor. And joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. How are you feeling with the results so far?
Yes, it's been a very, very busy week, hasn't it, Kien? And my second week in a row on taking stock, so plenty to talk about. So let's get ahead.
Yeah, thanks for filling in. I know the other guys are very busy during this time, so I appreciate it, Matt. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, what a difference a week makes, doesn't it? Last time we spoke, the Australian market was hitting record highs, and over the last few days, though, it's practically given back most of its gains over the new year. So I think it all began to unravel after the banks, specifically Bendigo and Adelaide Bank, released its first half results, followed by quarterly updates from Westpac, NAB, and ANZ. And the banks make up about 20% of the Australian market index. So large falls across this sector can weigh significantly on the market, but the banks were able to sustain and increase their dividend payments. So what's been the reason for the poor market reaction?
Look, I think it's a combination of factors, Ken. The banks had been massive outperformers throughout 2024, and I think that momentum did stretch share prices relative to their underlying fundamentals. So most, if not all, the banks were trading at significant premiums to their fair value before the results. But the broad theme in the banking season has been related to net interest margins and net interest margins pressure specifically. For those that aren't familiar with the metric, net interest margins are effectively the difference between the loan rate they charge and the deposit rate that they pay. And this is essentially the core to their profitability. The pressures on net interest margins were driven by rising spreads in wholesale funding markets and increasing competition in term deposit.
Yeah, and I saw that Bendigo and Adelaide Bank, they were worse hit. And if you think about it, it's due to their regional status and lower credit rating, making funding costs more expensive. So that's affecting that net interest margins you're talking about, Matt. And with their regional branch network as well, they do have a higher cost to income ratio compared to the other major banks, making it harder to generate an attractive return on equity. And despite this, Bendigo was able to sustain their interim dividend at 30 cents per share. And following the share price reaction, this now translates to a gross dividend yield of around 8%.
Yeah, reasonably attractive, isn't it, Ken? And the banks were also contending with, similar to many large companies with a lot of employees, these inflationary pressures on their cost base, with obviously rising staff costs. And in addition to that, there's increased technology spending, especially around this AI thematic, which also did contribute to the negative sentiment. And meanwhile, we also saw deterioration in loan quality, and this was evidenced by the NAB's first quarter update. Hence, this provided the market with a reason to sell the banks off. And as we said, they were trading at historically very high price to earnings multiples.
Yeah, Matt. And after this week, we do expect slight earnings downgrades to flow through for the banks under Golden Rule 3, though. But we believe it's not material enough to derail the sustainability of their dividend yields moving forward. Currently, the banks are on quite attractive forward gross dividend yields, ranging between about 4.4% for Commonwealth to around 8% for Bendigo Bank. Now, moving across to some of the other star stock highlights for the week, let's focus on annuity provider Challenger, which is both a star growth and star income stock. The results seemed okay, with the business generating a 12% rise in normalized net profit and a 120 basis point improvement in its return on equity above management's target range. It also increased its interim dividend by around 12% and maintained its full year profit guidance for around 10% earnings growth. So, Matt, why was it sold off so harshly?
Yeah, interesting points that you make there, and because on the face value, it did look like a reasonable result, but the core business at about 81% of revenue is its life annuity business, and total sales did fall by 12% due to increasing competition from banks on its fixed term annuity products. And there was also weak institutional sales. In addition, it did experience investment losses, which weighed on its result.
Yeah, but despite this, Matt, our analyst does believe that its full year guidance for 10% growth is achievable. Remember, its earnings have historically had a second half skew, so it looks like it's achievable from here.
And business is also undertaking a structural reduction in its expense base by outsourcing its admin systems. It's also relying on major technology transformation in its life platform, which should deliver further cost savings. And this will provide a base of future earnings and dividend growth. Challenger is currently on a gross dividend yield of about 7.4% and is expected to go ex-dividend early next week on the 25th of February.
And moving on to another stock this week is hearing implants manufacturer Cochlear. They dropped after downgrading their earnings guidance. And what can you tell us about the factors that may have led to this downgrade?
Yeah, there's a few factors at play here, isn't there, Kien?
Mm.
The US cost of living pressures have led customers to delay upgrading their sound processors, impacting services revenue. Additionally to that, Cochlear is facing challenges like audiologist shortages and potential impacts from US tariffs.
Yeah, longer term though, Matt, I noticed a key risk to the business is the impact of vaccines on the market, especially those related to childhood deafness. Currently, vaccine for a major cause of childhood hearing loss is in development, and if successful, this could reduce the number of children needing cochlear implants. So, could this indirectly affect Cochlear's market opportunity and growth forecasts?
Yeah, it could. Pediatric implants make up around 35 to 40% of the market. So any breakthrough here could impact future growth. But despite near-term headwinds, the long-term growth drivers still do remain strong. And aging populations, rising awareness of hearing loss treatment, and advancements in implant technology should support demand.
Look, there are risks there at the moment, but Cochlear is also expanding into emerging markets where penetration rates are still low. While risks do exist, their strong market position and continued research and development investment should drive the future growth going forward.
Yeah, that's right, Ken. So look, share price volatility could present an opportunity for long-term investors. If you go back historically, it always has for Cochlear. With the vast number of star stock results coming out this week, like Telstra, Brambles, Redox, Spark New Zealand, and Infomedia, please refer to our key update section and commentary for full details. Looking ahead, it will be another action-packed week to end the reporting season, including announcements from APA, Group, Endeavour, Lavisa, Woodside, and IDP Education. So please refer to our corporate calendar for more details.
In Under the Microscope this week, we take a look at Step One, an online underwear retailer which has generated high returns on equity and also strong profit margins because of its direct to consumer channel. Now, it has no rental overheads and relies solely on online marketing strategies by sponsoring athlete influencers, selling directly through their website and also via distribution agreements with Amazon. So, this is a founder-led business with Greg Taylor holding a 58% stake in the business. So, with regards to its results, though, sales actually rose 7% on year. So, why was the stock sold down so much?
Yeah, look, with retailers, it's all about sales momentum and profit margins. And although sales growth appeared reasonable, it was significant slowdown to the growth achieved in the prior half at 35%. In addition to that, profit margins fell due to high promotional activity. So the quality of the sales growth was actually quite weak.
Yeah, management did note that conditions have been challenging, which has forced them to make additional investments in marketing. So this could put further pressure on their profit margins, and the lack of covering analysts as well suggests that Golden Rule 3 outlook needs to be taken with a grain of salt.
Yeah, and look, and this outlook uncertainty also means that investors should assess the risk carefully before taking on any exposure. This was clearly articulated in Charlie Song's initiation commentary, where he highlighted the competitive nature of the underwear market and the low barriers to entry.
Yeah, and also earlier in the financial year, we did see two directors of the company sell down a significant part of their shareholding. At the time, though, we didn't think that it was going to have a significant impact on the business's prospects with the potential benefit of added liquidity. Even with hindsight, though, it is hard to say if director sell downs are red flags, given there are both horror and success stories, like, for instance, WiseTech, for example.
Yes, WiseTech is a good example, isn't it, Kien, here, where director sell downs don't necessarily lead to future downgrades. But back to step one here. It's obviously now trading at a significant discount to fair value under Golden Rule 5, but we should expect that the only one covering analyst will be amending or changing his price targets over the coming days. So we expect that number to be downgraded.
Yeah, and we're currently reviewing the stock given the heightened risk, especially to their margins there. And I noticed that the stock has triggered an exit on the SD30 TSR, that's the stop loss indicator. And this can be useful for those who are trend sensitive, and it's proven to add value over the longer term. For now, trend sensitive investors should remain on the sidelines until the stock triggers a re entry signal, as long as it remains a star stock. With the RBA cutting their interest rates for the first time in around 4 years and the banks under the spotlight this week, an interesting question is, how will falling interest rates impact the profitability of the banks?
Yeah, very good question. And it's not so straightforward because a reduction in interest rates can have both positive and negative impacts to various parts of the banking business. Now, on the negative side, declining interest rates do lead to lower interest margins, which is money banks make by lending at higher rates than they pay in deposits. This margin narrows because banks may struggle to pass on lower rates to depositors. In addition, lower rates force depositors to go elsewhere, which would force banks to see more expensive funding arrangements.
Yeah, some good points, Matt. And another issue also to keep in mind is that lower rates can lead to lower returns on so-called what they call replicated portfolios. These are portfolios for the banks which help them manage their interest rate risks by investing in government bonds as well.
But on the positive side, lower rates make borrowing cheaper, which can boost home and business loan growth demand. It also reduces the likelihood of loan defaults and bad debts. In addition, lower interest rate expectations mean that more borrowers shift towards variable rates, which have higher margins.
Yeah, so there are positive and negative benefits of interest rate cuts, but considering the current environment, what is that net effect, especially of low bad debts and also a maturing housing cycle? The negative impacts on the banks, such as net interest margins, is more likely to outweigh those positives, which are more or less sensitive now. But despite this, we do not believe that this will have a significant impact on the bank's forecast dividend yield moving forward. But that's all we have time for today. Thanks, Matt, for your contributions.
My pleasure. And if you have any questions, again, join us for Lincoln Live on Monday morning.
Yeah, it's been quite a volatile week with some star stocks in our portfolios, going up and down and going crazy. But please ensure you remain diversified, invest in those quality businesses, and continue to monitor announcements and star stock changes. And also, don't forget to read our commentary. Take care and have a happy, healthy, and prosperous week ahead.